Well, thank you for joining us once again on our brief explanation of certain financial strategies that we find are very helpful for our clients and people that we do work with. Today, we're going to talk about the cost of a tax-free income plan. I've made reference to 7702 plans in regards to overfunded life insurance with the benefit of accessibility to money on a tax-free basis. So today, I would like to go over the costs of those plans. And to do that, I'm going to compare a 401k excess contribution and take that excess contribution and put it into an overfunded insurance plan. And then on the second part, I'm going to compare the actual costs of the internal plans. So to get you going really quickly, I'm going to use a gentleman 45 years old, and the investment return is 8% less the asset fee cost. And I'm going to put them for simplicity in the 31% tax bracket. There's 250,000 in the 401k now. They contribute 16,000 of their own money. The employer will match up to 4% of salary or $6,000. So we have $22,000 going into the plan, and the net amount that's actually coming out of the employee's pocket is 16,000 over and above the match. So you're going to see two things here. I'm going to use a 401k, and that'll be plan A, and plan B is going to use the same concept, except I'm going to exhaust the 401k between age 65 and age 80 and allow our tax-free plan to fund from 80 to 100. So when I take these numbers and I put them in the plan itself, what you're going to see, I'm going to keep this so everybody's focused on plan A and plan B. Now, plan A is the actual plan. There's no pension payout. But if I took the future value at 7% net and the contribution money, all the money going in, that would have accrued $1.9 million. At 7% rate of return, the net payout between age 66 and age 90 would be $154,000. Now, there's going to be taxes on this money, and that tax is at 31% marginal bracket, and we'll use that, is $48,000. So the employee nets $106,000. On the other hand, if he just contributed his $6,000 and with the match, he would end up with $1.2 million in 401k money. But if he took the $16,000 and he put that money into the tax-free income plan, that would have generated about $76,000 of tax-free income. So when you take the 401k plan plus the overfunded insurance plan, there's a total gross of 175 coming out between ages 66 and 90. Well, that's the gross figure. But remember, we still have to pay taxes. And the taxes are being paid on the 98,000 as the 48,000 was being paid on the 154. But you notice the 176 is totally tax-free. So the net result is that this person ends up with a net spendable dollar of 144, which is $37,849 more than if he stayed in a 401k and put all his money there. Well, that's 35% more tax-free money. And over the course of this time of 66 to 90, by using Plan B, the employee would have received $946,225 more in net income. So let's take the tax results. That's quite a substantial amount. But I'm going to show you the tax results very quickly. This is just the representation of the money going in. The employee puts 16,000 in, takes that full deduction on a full plan. The net cost is $11,000. So he's going to put in $320,000, take a $99,000 deduction. So his net cost to be in this plan is $220,800. However, in Plan A, where he was taking out the total income, he's going to end up paying $1.2 million in taxes on his total payout between 66 and 90. Now, when I take that total liability against what he saved, 99, his net cost is 1.1 million. But when I compare him only putting in a contribution for the match, he's going to put in $6,000, and his total deduction would be $1,800 per year. His net cost is $4,100, so he still would have $120,000 contribution. His tax deduction's $37,000, so it only cost him $82,000. But he's going to pay a substantial lot less amount of taxes between the 1.2 and the 700 coming out, any money coming out of the 401k. I'm going to apply his tax savings. So his tax cost is $727,000 if he does Plan B, which is $400,000 more or less than if he did a full 401k contribution. You see this 2.1? All that is really saying is that when he starts distributing his income at age 66, he is going to, within 2.1 years, pay more taxes than what he saved within 2.1 years. So in this particular case, he had tax deductions for 20 years, and he's going to end up eating them all up in 2.1 years. So that's the tax results. Now, very quickly, I want to get to the mutual fund comparison, because as you know, there's a difference between the costs. What I did here was very simple. You won't see it all. I took the total contribution of 256 and just let the money build up at that particular rate of return. We used 7%, 8% minus a fee of 1%. And the bottom line was, this gentleman put 256 in. When he gets to age 85, let's say we emptied all out at that point of the game, he first of all would have had fees of his fees were $589,000. You can see that up here. And he would have paid taxes of $1.183 for a total of 1.7. Now, I did take his tax savings into consideration off this 1.2. My bottom line is that his total mutual fund fee and taxes was $1.7 million. His total insurance cost was $176,968. So the difference is 1.5, almost $1.6 million of cost. So my point being is that when people think that insurance costs a lot of money, you have to compare it to what's the cost of a mutual fund, a 401k, when you add their costs and also the taxes involved with that. Well, to finish up, you'll see Plan C. Now, all Plan C is really doing Plan B, in other words, making the contribution on the amount of money that would be matched and putting the excess contribution into funding a tax-free income plan. But here's the difference. At age 66, this gentleman would he would actually exhaust all of the 401k money over that period of time. Let's call it 15 years. The payout would be $126,000 less taxes. They would net $87,000. At age 66, no more contributions would be made to the insurance plan, but the money would continue to grow. So at age 80, they can start taking tax-free money out, which would be $248,000 a year. Now, my point of this is that chances are this part of the program is going to help supplement what he needs here, almost like a personal bank. But that would be determined by other income, Social Security, how much they need. But my point is this concept can be used to say, hey, I'll use my 401k as a base, but then I always have this money that I could tap anytime I want, and anything I take out is tax-free. Well, I've given you an awful lot, and it's taking longer than I thought I would take, but go back to some of the videos that I have on YouTube here under NECGGINC channel. Also, you can go to our website, necgg.com. I have some tax-free saving presentations there under Tom's Favorite Workshops. You can go to my blog, My Financial Mistakes, or if you have questions, certainly email me. Thanks again for taking some time and listening. I hope you learned something. Thank you.